our market master for the day now joins in. Jyotivardhan Jaipuria, Head of Research, Bank of America, Merrill Lynch. Hi, Jyoti. Good morning. Good to have you with us. Actually, let's start with the micros first. We just had information, a reporter breaking the news that the Commerce Ministry has cleared a DIPP note which argued in favor of 100% FDI in defense. You'll have some of those stocks in your list. Is this going to make a seminal difference in this year itself? You see some money coming in if it's law?
Yeah, I think, more than whether it will make a difference in this year is like the signal that the government is going to send, because my view is that we'll see a lot more of liberalization of the FDI. So, the signal would be that we are open for business, we are going to encourage industry to come in, we are going to encourage foreigners to come into Indian industry. And I think, that's the critical message, because in the first few weeks of the government, people are looking at, okay, what is the game plan, what is the future roadmap? And announcements like this will, just create a lot of optimism.
Jyoti, hi, good morning. I was going through your note where you have a buy call on BEL, and you suggest that that could be the best proxy to play this defense sector. Apart from BEL, are there any other stocks? I know you don't generally talk stocks, but is there anything else on your radar that would be, the best way to sort of play this theme?
Yeah, we're not allowed to talk stocks like you said, so we can't take particular names. But, there'll be suppliers to the defense sector which will benefit. So a lot of people who are into capital goods and who supply to the defense sector would benefit from this.
Okay, now for a slightly larger canvas, like you said, you are expecting FDI-related announcements. What are the sectors on your radar?
See, I guess they'll go step by step, and so many sectors would turn up, but the general impression which they gave when they came in was 49% would become some sort of automatic limit in lots of sectors, except a few where they'll specifically say that 49% is not allowed. So that would be a sea change from what we have today, and it would just mean a lot of liberalization coming through. So I think FDI is going to be one leg of their whole plan to kickstart the economy. The other leg is going to be the domestic projects and how they can, accelerate the approvals so that they start kicking through. So I think, we'll see a two-pronged approach, both trying to attract foreign investment as well as domestic investment.
Okay, there's just some positive statements coming from Governor Rajan. Public inflation expectations have come down. That's important. The Reserve Bank does a regular 3-month survey of households. So the governor would know. And usually the Reserve Bank policy tackles inflation expectations, not inflation itself. So the fact that it has come down clearly indicates that he doesn't see an immediate need to increase rates for sure. Remember, the last number we have is 8.6 CPI inflation, and our repo is only at 8%. But what this key sentence is ruling out is that he is, on the front foot to raise any rates at all. As well, he's speaking fairly positively of the new government's plan to tackle food inflation. So those are some positive statements clearly for the bond markets. Maybe pull up bond prices. The bond markets rallied anyways, probably with global sympathies. Yes, at the moment they're not reacting to this. Maybe they have an auction to tackle. They're worried more about that.
Okay, but positive statements coming in there from Governor Rajan. But Jyoti, we've covered a couple of conferences in the last 1 week, the Axis conference, the Macquarie conference, and the mood seems to be unequivocally bullish at this point. But most experts believe that before taking the next plunge, you need to see what kind of concrete measures the government will announce. Do you think one should wait that long? Because the noises so far have been quite good.
Yeah, see, it's like each guy has his own view on whether one should wait or one should anticipate the move, because quite often if you wait, you may not be the first person to enter the market and you may end up entering at much higher levels. From my point of view, it is, okay, our business is to forecast and our business is to predict the future. So we are expecting things to turn positive. We think, there'll be a lot of positive announcements coming through. So we've been quite bullish on the markets actually.
Okay. Jyoti, if one is betting on a sea change in the economy itself, you should have a lot of cyclicals, especially beaten down cyclicals. You don't seem to be terribly in favor of PSU stocks. I can see only SBI on your list.
Yeah, like if you think of our overweights, we have four overweights. All of them are cyclicals actually. So we are overweight auto, we are overweight cement, we are overweight industrials, and we are overweight banks. The fifth sector we are overweight on is the oil sector, which is, probably more linked to subsidy than linked to the domestic economy. So in that sense, we are overweight only the domestic cyclicals actually. We don't have any exporters. We don't have.
Yeah.
So it's a big change from what was there last year.
Fair point. Okay, what about foreign interest itself? We are seeing last 5-10 days, almost since May 16th, we have seen either lack of buying or actually tepid selling by the foreign investors. Is there a resistance that shares are a bit expensive at this point in time?
Yes, I think we have to put it in the context that we've had like a near 20% rally in the last 3 months. People bought in anticipation of a strong government coming through. So it's been more the case of, okay, I bought, markets are up quite a bit, let me sell a bit on the news and then wait and watch. So I think, typically you see that every time, you buy the rumor and you sell the fact. So this time also it was no different. And now, people are waiting and watching that the government has just taken over. Let's see what the announcements will come. And at some point we'll see people feeling a bit more comfortable and they'll get into the market. Markets are not cheap, so that's one thing we have to remember. In fact, our view is that this year the markets will be expensive through the rest of the year. It's not going to be a cheap market, but it's anticipating that things will change over the next couple of years in the economy as well as in earnings.
So what do you do with a sector like IT that is in any case not the flavor of the month, and then you have some shocks coming in from names like Infosys, etc. Do you push those sectors to the back burner?
Yeah, so it's not something which we are terribly excited about at the moment. It's these were sectors which we liked for the last couple of years. We liked IT, we liked pharma. So I think they are having two struggles now. One is, people's view on the rupee now is changing. So it's more like rupee will be flattish to maybe slight appreciation, which, probably will hurt the prospects a bit. The second is these were sectors people owned in a big way till a few months ago. So incrementally for most people it is, I want to buy the domestic names which I don't own as much. And so, you see a bit of selling coming through in these. So valuations are starting to look quite reasonable in some of these names. But at the moment we're still avoiding these sectors, still focusing on the domestic plays, which is where we think a lot of earnings upside could come through in the next few years.
So you see this hump of 7,500 on the Nifty or 25,000 on the Sensex being taken out pretty quickly, maybe before the budget or something. What are the year-end targets, as in December 31st?
Yeah, so our year-end target is 27,000. So it's like quite a lot of upside from the current levels. Whether it happens before budget or after, so it does not really matter as long as you believe that, okay, you're making a reasonable return over the rest of the year.
So, Jyoti, the last time when you joined us, you had indicated that, this is a market which looks like it could be set for a re-rating on a valuation basis. And a lot of people have indicated from the 14-15 times, there could be a clear case for a move towards, even 18-19 times, that could be justified as well. How are the valuations stacked up at this point post the run-up, and what is your expectation for FY15?
Yeah, so just now if you look at the market, it's probably trading around 15.5 times 1 year forward. Like I always do a rolling 1 year forward, so it's trading around 15.5 times 1 year forward. And as we move into the year, we'll probably see it becoming more expensive. So our year-end target is pegged at a valuation of around 16.5, 17 times. So that's the sort of number we are looking at. Now what we have to remember is every time we say market can go up to 18 times and 19 times, what it presumes then is that we are going to get a sharp earnings upgrade coming through, we're going to get a sharp earnings acceleration coming through. So 19 times is not a sustainable, but if you're close to a bottom of an earnings cycle and you're paying 19 times for that, then you're assuming that 2 years later the earnings catch up would be so sharp that this 19 times would go back to 14, 15 times. So we are probably somewhere in that stage where margins are at an 18-year low. We think market margins over the next 2-3 years could go back, probably not to old levels, but at least it will revert somewhere close to the mean, and that's why earnings will see a sharp acceleration.
Okay, your note recommends ONGC as a reform play. Are you expecting some rapid oil sector reforms? After all, it's going to be a cash-strapped government, and at least for the first year, the temptation may be to keep the balance of fuel subsidies, LPG and kerosene, with the oil companies. Should you buy right away or wait for something in this sector?
See, like the UK government provided the roadmap for elimination of diesel subsidy because they kept doing this 50 paise increase every month, and remarkably they did it through most of the election season also. The difference which is there is not too much now. So, probably by the end of this year at the latest, and my guess is it could be earlier, we'll probably see elimination of the diesel subsidy at least, which would be very positive because that, used to contribute the bulk of the subsidy coming through. So that's really the thing, that here is a sector which for the last 7-8 years has been dogged by subsidy. The whole, for investors it was a nightmare because trying to figure out how much subsidy would be given to the company or something only at the end of the year. And if the subsidy is eliminated, then it gets into a normal company again, that okay, I know how to model it, or at least I have to forecast, refining margin, I have to forecast oil prices, and then I know how to model this company. So I think that's where the investor interest will come back into this whole public sector oil space, and that's the reason we like it.
You interact with a lot of foreign investors as well, Jyoti. Are you getting a sense that long-only funds or long-only investors are really underinvested in India at this point, and a lot of the money that's waiting on the sidelines could flow into India through the course of, say, the next 6 to 12 months versus other emerging markets?
Yes, actually, I don't think people are underinvested in India. If anything, people are overweight India. Most of the work which we do, most of them show that, people are overweight India. We've seen a sharp amount of flows in the last 2-3 years. So to that extent, the thing is, new money will come in either from two sources. One is people increase their overweight position on India, or second, it could come because, they see more inflows coming through and they allocate to India also along with other markets.
All right, Jyoti, we'll leave it at that. Thank you very much indeed for joining us with your thoughts
Thanks a lot
on all these sectors.